to Economic Insights, the show where we make sense of what just happened in global markets before you've finished your weekend coffee. I'm Alex, your host, and joining me as always is Selim, market veteran, producer of this show, and someone who has clearly not slept much this week.
I've had stranger weeks, Alex, not many, but a few.
Where do we even start?
At the beginning of the most dramatic week in global markets in quite some time.
All right, set the scene for us. Because from what I saw, this week started somewhere between tense and terrifying.
That's accurate. The week opened with President Trump having issued a hard deadline to Iran: open the Strait of Hormuz completely, allow free passage of oil, or have your civilization end. And he was colorful. He was threatening to destroy Iranian bridges and power plants. The market read that as an existential threat to one of the most critical choke points in global energy supply. Brent crude was trading above $111 a barrel. Equity markets were on edge, and the Strait, which in normal times handles something like a fifth of the world's daily oil supply, was moving traffic at roughly 5% of pre-war volumes. We were in genuine crisis territory.
And then everything flipped.
Midweek, Pakistan brokered a 2-week ceasefire between the US and Iran. Trump agreed to suspend military action on the condition that Iran allow the strait to reopen. Markets erupted. Brent crude dropped 13 to 15% in a session, back into the mid-90s. Global equities surged. European stocks up over 5% in a day. Korea's Kospi jumped more than 7%. Emerging market equities posted their biggest single-day rally since March 2020. Bond yields fell. The relief was enormous.
Trump declared victory.
Don't you know? He always wins. Reality is inconsequential. Total and complete victory were his words. Markets believed him for maybe 24 hours, because then the details started emerging, and the picture got more complicated. Kuwait and the UAE were intercepting drone strikes. Israel unleashed a massive assault on Lebanon. And critically, Iran did not simply reopen the strait. Instead, they moved to severely restrict traffic, a handful of vessels per day, warned of sea mines, and began insisting on transit tolls. You had a ceasefire on paper, but no change in practice.
So the oil price didn't go back to where it was before all this started.
Exactly. Brent ended the week around $96, down massively from $111, but nowhere near pre-war levels, and the market settled into a watchful, cautious posture. The good news ending the week was that a U.S. delegation, led by Vice President J.D. Vance, is in Islamabad this weekend for direct peace negotiations with Iranian officials. The talks have started. That's meaningful. The ceasefire expires on April 21st. That's the next hard deadline everyone is watching.
And there was also economic data this week, CPI and consumer confidence. How bad was it?
Both bad and revealing. Headline US CPI for March came in at 0.9% month on month, 3.3% year on year, the hottest monthly print since mid 2022. A 21% spike in retail gasoline prices did most of the damage. Core CPI, which strips out food and energy, was actually softer than expected, at 0.2% month on month, 2.6% year on year. So the underlying inflation picture is more stable, but that headline number will make headlines, and it feeds directly into consumer psychology.
Which brings us to the confidence data.
The University of Michigan's preliminary April reading dropped to 47.6, down from 53.3 in March. That's a record low. The current conditions gauge also hit a record low. The expectations index fell to its weakest level since 1980. And consumers, when asked where they expect inflation to be a year from now, said 4.8%. That's a full percentage point jump in a single month. They see costs rising 3.4% over the next 5 to 10 years. Gasoline above $4 a gallon, which is the highest since 2022, is doing real psychological damage. People are anxious, and anxious people tend to cut spending.
Before we move on, I know you also wanted to mention the jobs data, but from the week before?
Yes, and I want to be transparent about this. We didn't have an episode last weekend, so the March non-farm payrolls report, which came out on April 3rd, didn't get covered. It's too important to skip. Be warned, this is old news but big news. The headline was strong: 178,000 jobs added in March, and the unemployment rate dipped to 4.3%. That sounds great. But dig underneath it, and some of that strength was artificial. Striking healthcare workers returning to their jobs, unusually warm weather pulling forward spring hiring, and statistical adjustments. Average hourly earnings were modest, the work week declined, so the headline flatters the underlying reality. The Fed's takeaway: the labor market is resilient enough that they don't need to cut rates. In fact, some members are now openly discussing the possibility of hikes.
Let's talk developed markets. With all this going on at the stagflation, energy shock, wobbly consumer, where is the Fed?
Frozen is the word I'd use. The Fed's March meeting minutes confirmed that participants are increasingly concerned about upside inflation risks from the Middle East. The vast majority voted to hold rates steady, but there's a split. Some want what they're calling a two-sided message, meaning rate hikes are back on the table if inflation doesn't fall. Others still believe rates should come down eventually. The current consensus expectation is that the Fed holds until September of next year, delivers a 25 basis point cut then, and another in early 2027. But the market probability of outright rate hikes above 4% has jumped to around 25%, up from about 5% before the Iran crisis. The Fed is not cutting this year. That much seems settled.
What about Europe?
Europe is arguably in a harder spot than the US because it's far more exposed to the energy shock. Germany is facing severe recession risk. Its industrial model depends on cheap energy, and cheap energy is gone for now. French industrial production was weak in February. Italy's services sector has tipped into contraction. The only real bright spot is Spain, which benefits from a stronger renewable energy base. The European Central Bank is expected to hike rates possibly as soon as June, with around 60 basis points of tightening priced in by year end. The irony is, the ECB may be hiking into a weakening economy because the energy shock is also an inflation shock. That's a deeply uncomfortable policy position.
And the UK?
Similarly uncomfortable. Headline inflation is heading toward 3.5% in March and could peak around 4.1% in the fourth quarter. The housing market is being hit. Rising mortgage rates from the energy shock have caused buyer inquiries to collapse. The Bank of England is expected to hold rates at 3.75%, with an 8-to-1 vote, though one member is likely pushing for a hike. GDP growth for 2026 is being revised down to around 0.7%.
And Japan, stuck between weak yen and rising prices?
Japan is in a classic bind. Higher oil prices crush Japan's current account because the country imports almost all of its energy. The yen has been under pressure, dollar yen in the upper 150s, with a risk of pushing toward 160 if ceasefire talks collapse. The Bank of Japan was building toward what could have been a meaningful turning point in policy. Their research pointed to negative real interest rates being unsustainable. Markets were pricing a 57% chance of a rate hike in April. That probability has since fallen. If geopolitical conditions stabilize, the hike is back on. If not, it waits.
FX and commodities. Give us the highlights.
Oil first. Brent is sitting around $96. The range of analyst views for the rest of the year is wide. If peace holds, prices could fall back towards $77. If the conflict escalates, $130 is on the table. The working baseline is $90 to $100 for most of 2026. Natural gas has actually been the bigger story in percentage terms, up over 65% since the conflict began, outpacing crude. Europe's gas storage came out of winter at its lowest level since 2011, just 18% full. Refilling before next winter is a major structural challenge.
And gold?
Gold is interesting. It moderated a bit this week, actually less responsive to the oil shock than you'd expect. But analysts have upward targets of $5,100 per ounce, for Q2 and $5,800 by year end. The structural story is dollar weakness. The dollar's share of global central bank reserves has fallen to a 30-year low, and gold is one of the primary beneficiaries of that diversification. Central banks in China and Poland are continuing to accumulate.
The dollar itself, how is it holding up?
Mixed picture. Short term safe haven, yes. But structurally, the conflict has shaken confidence in the dollar as the anchor of global payments and savings. The USD index technically faces resistance near 100 and could drift toward 97 to 98. The euro has been surprisingly resilient. It could rebound toward 1.19. The yen, as I said, is fundamentally weak. And commodity currencies like the Australian dollar are caught between higher commodity prices and the reality of being energy importers, with central banks hiking into slowing economies.
Emerging markets. Where do things stand?
The broad picture is that EM got hit hard during the conflict, with the largest energy importers, South Korea, South Africa, Egypt, Thailand, suffering the worst. The ceasefire triggered sharp rebounds in exactly those markets. Foreign equity inflows have cautiously resumed. If peace negotiations succeed, analysts expect inflows to accelerate significantly.
Let's go country by country. China?
China has shown real resilience. The yuan held firmly below 7.00 against the dollar throughout the conflict. That's a signal of policy resolve. Chinese manufacturing PMI returned to expansion in March at 50.4. And in a striking development, Chinese producer prices turned positive for the first time in 41 months, up 0.5% year on year, partly driven by the oil shock lifting upstream costs. Consumer prices remain subdued at 1% year on year, which gives the central bank room to ease modestly if needed. The key risk for China is a prolonged strait closure disrupting supply chains and weighing on export demand.
India?
India's central bank held rates unanimously at 5.25% and maintained a neutral stance. But the inflation outlook is being revised up. Headline CPI forecast for the coming year is 4.6%, with upside risks from energy and potentially a poor monsoon if El Nino conditions develop. The rupee has been volatile because of regulatory changes. The central bank restricted certain offshore hedging activities, which forced some sharp positioning moves. The rupee's current account deficit could widen meaningfully if oil stays elevated.
Turkey?
Turkey has taken real punishment. Cumulative foreign outflows from Turkish assets since the conflict started have reached $33.5 billion. The central bank had to spend roughly $23 billion in net FX interventions over a 2-week period to defend the lira. The net FX position, which was around $70 billion before the war, has dropped to approximately $13.5 billion. That's a dramatic erosion. Deposit dollarization sits at 40%. The good news: Turkey has diversified its energy import base considerably in recent years, and the energy deficit is manageable. But this has been an expensive episode.
South Africa and Egypt?
South Africa is one to watch positively if the ceasefire holds. Gold prices support the fiscal picture, the banking sector has been stable, and consumer confidence didn't collapse the way you'd fear in a crisis like this. Analysts are cautiously constructive. Egypt is under more pressure. The Egyptian pound has depreciated, and higher oil prices raise import costs significantly. That said, at current levels, Egyptian treasury bills offer attractive carry for offshore investors willing to take the FX risk.
And Hungary? You said we needed to cover this.
This is genuinely consequential, and not just for Hungary. Prime Minister Viktor Orban is facing what analysts are calling the toughest election of his 16-year rule. He's trailing his challenger, according to some, by double digits. If opposition Magyar wins, the market implications are substantial. Frozen EU funds would likely be unblocked. Hungary could be put on a credible path toward eventual euro adoption, and the Hungarian forint could appreciate 10 to 15% over the medium term. For Europe, a change of government in Budapest would be a major geopolitical event. Orban has been the EU's most difficult internal relationship for years, maintaining close ties with Russia and opposing EU aid to Ukraine. An Orban defeat would be a significant shift in the European political landscape, with markets pricing it as a meaningful positive for Hungarian assets.
What are the major things to watch next week?
Three main tracks. First, and most important, the US Iran peace talks in Islamabad. Everything else is secondary to this. The ceasefire expires April 21st. Whether it holds, whether it's extended, whether it progresses towards something more permanent, that drives oil. And oil drives inflation expectations. And inflation expectations drive everything in fixed income. Markets are on a hair trigger for news from Pakistan.
Second,
The IMF and World Bank spring meetings in Washington running from April 13th to 18th. The IMF's World Economic Outlook drops on Tuesday, and it will almost certainly show significant downgrades to global growth and upward revisions to inflation, the stagflation narrative in official form. Listen for the press conferences because the messaging around policy responses will matter.
and third,
China's Q1 GDP, due Thursday, alongside March data for industrial production, retail sales, and fixed asset investment. This is the most important growth data point globally right now. If China is holding up, it provides a partial offset to the Middle East drag on global demand. If it disappoints, we have simultaneous supply side and demand side problems.
and U.S. earnings season.
Kicks off this week, and it's going to be interesting. Tech names including TSMC, ASML, and Netflix all report. The bar has been lowered by all the geopolitical uncertainty, but guidance is everything. Companies that can't give clear forward visibility are going to be punished. On the macro data side, US PPI on Tuesday, the Fed's Beige Book on Wednesday, and jobless claims Thursday.
A lot to watch. Thank you as always, Selim. And listeners, as we always say, we do not give investment advice. For that, please consult a professional. We'll be back next week, and hopefully with better news out of Islamabad.